This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Bullish response. That's how the markets reacted to the secession vote in Ukraine, with the Dow snapping a 5-day losing streak to post its biggest gain in 2 weeks. But how long will the rally last?
Big decision. Janet Yellen will lead her first policy meeting as the head of the Federal Reserve this week. And many say she may be ready to make some changes.
And the CEO speaks. General Motors head Mary Barra makes a public admission about those recalls and plans to change the way the company handles investigations. But was she persuasive? All that and more tonight on Nightly Business Report for Monday, March 17th.
Good evening, everyone. It's St. Patrick's Day, so there was a lot of green on Wall Street today. And we're talking about green arrows, a relief rally thanks to no violence following the referendum vote in Crimea. We'll have more on that in just a moment. Now, a report showing manufacturing output jumped the most in 6 months also added to the positive feeling. On Wall Street, the Dow surged 181 points, the Nasdaq rose 34, and the S&P 500 up almost 18 points. All three indices had their biggest one-day gain in 2 weeks.
As the markets here rose because of that lack of violence in Ukraine, tensions between the United States and Russia are also rising. Some call it the worst superpower dispute since the Cold War. The U.S. and European Union slapped sanctions on Russian and Ukrainian officials after a vote over the weekend paved the way for Russian President Vladimir Putin to annex Crimea from Ukraine. The economic sanctions are the most visible signs of Western anger at Russia. Still, President Obama says a diplomatic solution can be reached before the tensions escalate further.
I believe there's still a path to resolve this situation diplomatically in a way that addresses the interests of both Russia and Ukraine. That includes Russia pulling its forces in Crimea back to their bases, supporting the deployment of additional international monitors in Ukraine, and engaging in dialogue with the Ukrainian government.
Steve Sedgwick is on the ground for us in Kiev with a look at what may happen next.
Here in Ukraine on Monday, everyone digesting that huge yes vote to join the Russian Federation from the Crimean people. Everyone now turning to President Putin to see what he does next on three fronts. One, does he and his Russian parliament give annexation of Crimea the OK and give it the thumbs up in the Russian parliament? Two, does he increase the pressure on Ukraine militarily? And three, how does he react to sanctions from the EU and the US? Politicians in Kiev, for their part, are adamant that the referendum is illegal. I spoke today to the Prime Minister, Mr. Yatsenyuk, who said to me he still wanted a diplomatic solution rather than a military solution to this crisis, although he and every Ukrainian must be prepared, he said, to fight for their country if indeed there is an escalation of Russian intent in the east of this country. This is Steve Sedgwick, the Nightly Business Report in Kiev.
Another market mover this week could be Federal Reserve Chair Janet Yellen's first news conference. She'll answer questions on Wednesday after presiding over her first Fed meeting as head of the central bank. Now, it's widely expected she will continue reducing the Fed's stimulus measures. But what's not so certain is what Yellen will say about some key targets on employment and inflation and whether she's ready to make some big changes. Steve Leisman has more.
Janet Yellen runs her first meeting as Fed chair this week and holds her first press conference, having promised continuity with her predecessor, Ben Bernanke. But she's going to have to make some changes and make them as soon as this meeting. Here's why. Back in 2012, with Bernanke leading the central bank, the Fed promised not to consider raising interest rates, then at zero, until the unemployment rate fell to 6.5%. Seemed like a safe and faraway bet back then. The unemployment rate was at 7.9% and seemed to be holding steady. But two things happened. First, the unemployment rate started falling rapidly, losing more than a percentage point in a year. And second, it wasn't clear that it fell for the right reasons. Many, in fact, were dropping out of the workforce.
The unemployment rate is not a sufficient statistic to measure the health of the labor market. An additional 5%, an unusually high fraction of our labor force, is working part-time for economic reasons.
The numbers are staggering. 7.2 million Americans are working part-time because they can't find full-time work. 10.4 million Americans are unemployed, 3.8 of which have been unemployed for more than 6 months. 91 million Americans are not in the labor force because they either retired or became so discouraged they dropped out of the workforce. So the big question is this: how many more workers and how many working hours are out there? If we're near full employment, workers can demand higher wages. That could threaten higher inflation.
There's a lot of work that suggests that long-term unemployment, and that's the unique feature of this expansion, the record levels, they have little or no effect on inflation. The only effect on inflation comes from the short-term unemployed, and they're back to normal levels.
If that's the case, Yellen could be forced to break with Bernanke on a much more fundamental issue, raising rates much sooner than markets think. For the moment, however, Yellen is convinced there's lots of slack in the labor market, so look for her to find a different way to communicate that slack to markets in the days ahead. For Nightly Business Report, I'm Steve Leisman.
Our guest tonight says the stock market is, quote, pricey, and tells investors to prepare for a correction. She's Erin Gibbs, Chief Investment Strategist at S&P Capital IQ. Ms. Gibbs, welcome. Good to have you with us. We could potentially see a correction of 10%. That's what you say. Why do you say it, and what should I do to prepare for that?
So the issue we have right now is that stocks are really priced for perfection. Right now, the S&P 500 is trading at about 15.6 times forward earnings, which means that you're paying $15.60 for every dollar that a company is forecasted to earn this year. Now, since the financial crisis, normally you'd pay more like $14. If you're going back even further, 15 years, you'd pay around $16. So it's not that we're a bubble or that we're, way above the historical range, but we're at the top of that range. So if this happens,
what should I do, Erin? Should I get out of stocks? Should I lighten up on certain kinds of stocks? What?
No, we're not saying sell. Again, this is not, I'm saying sell, but I'm saying use any corrections as opportunities to get in. Right now, it is extremely hard to find good values. Like I was just saying, we're sort of at the top of that historical range. Now, in good economies, you can go much more expensive, but use any pullbacks, any disappointing news as opportunities to get into more equities. We still expect another 10% for the year.
Right. I mean, this is certainly a headline-driven market. We saw last week all the worries about the Ukraine, big sell-offs. Today, relief rally because of new developments in the Ukraine. Now we've got the Fed. You heard Steve Leisman's report. What's the most important decision that could come out of the Fed this week from Janet Yellen that could impact the markets? And what do you think the market reaction will be?
For us, it's all about whether she's going to raise the rates or go further into the language saying she's not just looking at unemployment. That's the biggest action that could really affect the market this week. If she raises rates, which is not what Wall Street is expecting, you could see a much bigger correction. Ultimately, I feel she's not going to raise rates. We're not going to look at any raising rates up until at least the second half of the year, or even 2015. But we're really looking for indication of language that it's not on the table right now.
In the short term, Erin, what is the biggest risk to the U.S. market? Is it China? Is it the Ukraine and geopolitics? Is it the underlying growth or lack of growth in the U.S. economy and corporate profits?
For us, it's more about the U.S. economy. Right now, think of it as we're firing on all four cylinders, but we're driving a Chevy Chevette, not a Ferrari. We really want to see more of the fundamentals come through and see those corporations start earning what we expected at the beginning of the year.
Well, carry on with that, because earnings are coming out in the next few weeks. At the end of the day, when all the numbers are finally out for this first quarter of 2014, is it going to be positive numbers for the markets or negative?
So we've seen a lot of revisions downwards, and that's where I'm really concerned about potentially having a correction. Estimates have come down from looking for about 10% profit growth for this year to a little about 7.5% growth this year. So, a pretty big revision just in 2 months. Now, a lot of it has been warnings about the weather has really hurt our profits and our revenues for first quarter. But that only takes you so far. Also, a lot of corporations are saying they're going to make up for it in the second half of the year. So we really want to see our companies able to beat those expectations as they did in 2013, And are we still going to be able to meet those growth expectations?
Erin, nice to be with you this evening. Thanks for joining us.
Thank you.
Erin Gibbs is Equity Chief Investment Strategist at S&P Capital IQ.
Investors are also watching closely China's currency. The People's Bank of China has decided to allow the yuan to climb or fall as much as 2% per day against the U.S. dollar. Now, most currencies, by contrast, are free-floating. This may sound like a small move, but it's actually a big step toward a more market-based economy. And as Sarah Eisen tells us, the shakeup could benefit some big American companies.
China wants a world-class economy, and to do that, it needs a world-class currency, one that can compete with the dollar or the euro. And China took a big step closer to that goal this weekend, letting the yuan float in a wider range against other currencies. That could help convince foreign investors that the Chinese economy is not slowing down and encourage investment.
In the long run, I think that it should make Chinese assets a bit more inexpensive, which could attract more investment. But they've got to get over the slower growth as well as the risk of further defaults.
It may also help the Chinese economy. Currency strategists have long held the Chinese government kept the value of the yuan low on purpose, making Chinese exports cheaper. But a stronger Chinese currency has a powerful upside for the global economy because the Chinese consumer will have more spending power. American companies that stand to gain from increased consumer spending in China include Yum Brands, McDonald's, and Procter & Gamble, among others. They've invested billions betting on the Chinese consumer, even if it means more ups and downs for the yuan.
When a country is making a fundamental shift in the composition of its economy away from investment-driven and export-driven and into domestic consumption-driven, that's bound to have some bumps and pitfalls.
Some will say that volatility will make the world's #2 economy look worse than it actually is. But for now, there's plenty of praise for China for opening up to the global economy at a time when other emerging powers, Russia for one, are pulling back. For Nightly Business Report, I'm Sarah Eisen.
Still ahead, GM's new CEO makes a public appearance and commits to resolving safety issues at the automaker. But was it enough? More Americans are out there looking for work, and many are finding it more quickly. The Labor Department says unemployment fell in 43 states in January, rose slightly in just one, Iowa, and remain unchanged in 6. North Dakota, which is riding that oil boom, continues to have the lowest jobless rate at 2.6% nationally. Rhode Island, which has suffered from a housing bust and sluggish manufacturing, has the highest unemployment rate in the country, 9.2%.
3 new recalls for General Motors, the automaker adding about 1.5 million cars to its list of vehicles that need to be fixed. Recalls that are unrelated to those faulty ignition switches that we've been reporting on recently. And today, CEO Mary Barra addressed how she plans to change the way the company handles defect investigations. Phil LeBeau has been covering this story for us and joins us now. So, Phil, this is the first time, I think, that we're hearing from GM CEO Mary Barra. Why did she do this, and how effective do you think she was in this public statement?
You know, Susie, I think she was fairly effective. I wouldn't call this a home run, but certainly they had to do something. And it was effective from the standpoint that they are finally trying to get in front of this story. Instead of reacting several hours, maybe a couple of days after some revelations come out, General Motors put out these 3 recalls, and Mary Barra, as you'll hear right here, she was fairly forthright in saying this is just the beginning of more revelations.
I want you to know that we are completely focused on the problem at the highest levels of the company, and we are putting the customer first, and that is guiding every decision we make.
That's just one of the comments that we heard from Mary Barra. This was an internal message sent to the employees of General Motors, but it was also posted on the website. It was also meant for outside consumption, and I think for General Motors, it was a good first step. Again, not a home run, but an important step to make the public aware that they realize the severity of the situation.
As you pointed out, Phil, 3 more GM recalls today. 2 questions. Is this a case of dumping all the bad news out at one time to get ahead of it? And secondly, does Ms. Barra need to face the press?
Well, she will face the press at some point. There's no doubt about that. How soon that happens remains to be seen. And yes, this is a case of dumping all the news, being as transparent as possible. I looked at these 3 recalls, which cover about 1.5 million vehicles. We're not going to get into all of this. In terms of recall notices, these are not the most earth-shattering, and I say that from the standpoint there's no injuries or deaths involved in these recalls, and one of them was brought to the GM Recall Committee less than a week ago. That tells you how quickly General Motors wants to be proactive here in saying anything that smells close to being a recall, get it out. We don't want to appear to be holding back any information at all.
Yeah, but you know what's amazing is that they have 4 investigations going on all at once. So how long is this going to drag on? It sounds like she's going to be in crisis mode for a while.
Crisis mode for a little bit, 4 investigations, at least 2 congressional hearings that we'll have within the next month. So it's going to continue for a while. This was all about trying to get in front of the story.
Phil, thank you very much. Phil LeBeau reporting tonight for us from Chicago. Speaking of recalls, Honda recalling nearly 900,000 of its popular Odyssey minivans. These are models 2005 to 2010. A fuel pump cover can crack over time, increasing the risk of fire. The problem will be fixed over the summer once Honda dealers have the new part they need. Honda says it is not aware of any crashes, injuries, or fires related to this problem.
A $10 billion telecom deal is where we begin tonight's market focus. Vodafone is buying Spain's largest cable operator, Ono, as it tries to expand operations in Europe. Now, this move helps the British telecom company increase its broadband offerings, and Vodafone will also gain nearly 2 million new customers in Spain. Shares rose more than 1% to $37.45. Shares of Amgen up on news that its cholesterol drug met study goals in a late-stage trial. The company saying the treatment significantly cut bad LDL cholesterol levels among patients. The stock rose 1% to $123.86. And Under Armour shares jumped on news that its board approved a 2-for-1 stock split. This is the second stock split since the athletic gear maker went public back in 2005. The retailer's CEO says he believes the move might broaden the stock's investor base. And that was certainly true today. Under Armour rose about 2% to $119.67.
Shares of Sears higher on news. The retailer's board okayed the spinoff of Land's End late Friday. The casual clothing retailer will begin trading on the NASDAQ in April under the ticker symbol LE. The stock rose almost 2%, Sears, that is, to $44.84. Shares of VeriSign plunge on concerns that its business may be hurt by a U.S. government plan to give up oversight of the Internet's domain naming system. Because of that, Cowen & Company cut its rating on the Internet Address Manager to market perform from outperform, citing worries that VeriSign won't be able to renew some of its .com and .net contracts. The stock tumbled as a result, nearly 6% to $51.68. Twitter's CEO Dick Costolo is planning what's being described as a personal trip to Shanghai, his first ever to China, where he will meet with students and government officials. The company declined to comment on what will be discussed with those officials. Twitter, as you may know, has been blocked by Chinese censors since 2009. Shares were up a fraction today to 52.05.
Here's another Chinese company to tell you about, Alibaba. It's not a household name, but soon could be. The Chinese e-commerce company is one of the world's biggest internet players and plans to go public here in the U.S. in what could be the biggest initial public offering since Facebook. So what exactly does Alibaba do, and why are so many investors excited about it? Josh Lipton explains.
It's an IPO sparking a ton of buzz. Alibaba has started the process of filing for a U.S. IPO, ending months of speculation about where it would go public. The Chinese e-commerce giant runs websites where consumers and companies buy and sell goods with each other. Alibaba then makes money off advertising, which accounts for the bulk of its revenue. Now the company will make a public debut, possibly one day bringing its business stateside and competing with well-known e-commerce giants.
Going public on the New York Stock Exchange or on NASDAQ will be a great branding event for them that could really help them be a very, very important force in the U.S. and in Europe as well, competing with the likes of Amazon and eBay.
Alibaba generated revenue of $2.3 billion in 2011, which then nearly doubled in 2012. In its most recent quarter, revenue surged more than 50% year over year. Alibaba is profiting from a fast-growing Chinese e-commerce market, which the company now dominates. Analysts at Raymond James peg Alibaba's valuation at $150 billion. That's especially good news for Yahoo, which holds a 24% stake in Alibaba. After taxes, analysts say that stake could be worth $25 billion. Yahoo stock has soared nearly 80% in just the past 12 months. Investors are excited about the Alibaba IPO and are piling into Yahoo to get a piece of the action. After the Alibaba IPO, analysts say there will be more pressure on Yahoo's CEO, Marissa Mayer.
Assuming that Alibaba goes public sometime in the third quarter, then by the end of the year, Yahoo really needs to show a clear path to growth again. And I'm talking about the Yahoo operations, not their sum of the parts, if the market is to embrace the Yahoo stock and continue to buy it.
No IPO since Facebook has created the kind of attention that Alibaba is now generating. Investors, bankers, and analysts are all anxiously awaiting more details about its business. One thing is certain, the future of e-commerce, Chinese IPOs, and Yahoo will all look a lot different after Alibaba's public debut. Josh Lipton, Nightly Business Report, Silicon Valley.
And coming up on the program, what the golf industry is doing to get back into the swing of things and prevent the cold, harsh winter from taking a bigger toll on business.
"28 attorneys general are asking some major retailers to follow the lead of CVS and stop selling tobacco products. The officials sent letters to 5 of the country's biggest retailers whose stores include pharmacies, warning that selling tobacco products potentially undermines anti-smoking campaigns. But so far, none of the companies, Walmart, Walgreens, Rite Aid, Safeway, and Kroger, and none of them have announced plans to follow CVS's example.
U.S. home builders are slightly more confident this month ahead of the spring selling season. A closely watched sentiment index rose thanks to a boost of new home sales in January to the fastest rate in more than 5 years. But builders are still concerned about a shortage of skilled workers, ready-to-build land, and rising costs for materials.
Senate lawmakers have released their first draft of a bipartisan bill to eliminate Fannie Mae and Freddie Mac. Under the proposal, the mortgage giants would be replaced with a new government reinsurer called the Federal Mortgage Insurance Corporation. It would provide homeowners assistance only after private creditors take the first 10% loss. This new entity would be financed with fees on lenders who want the government backstop.
And finally, the official start of spring is this Thursday, but winter's not done yet. A storm blanketed the mid-Atlantic region today, dumping several inches of snow in the Washington, D.C. area, forcing federal offices to close. While ski resorts have benefited from this long, harsh winter, the opposite has been true for many of the nation's golf courses. Dominic Chu takes a look at how the golf industry is taking a swing at spring to make up for those winter woes.
The harsh winter in much of America has taken a toll on the game of golf. According to the National Golf Foundation, golf courses across the country lose an estimated $50 million for each day that they remain closed for things like weather. That's a real impact on a lot of local economies. The golfing industry is looking to find ways to fight back against winter's chilly grasp. Golf equipment makers like TaylorMade are setting up these kinds of urban driving range venues to drum up interest in the game. And there's a good reason why. The golf equipment and apparel business is a $5 billion a year industry, and they want golfers to start thinking a little less about winter and a little bit more about spring. Celebrity golf instructor and former Tiger Woods coach Hank Haney is eager to get golfers back into the swing of things.
I live in Texas, so it hasn't been too bad, but obviously here in the Northeast it hasn't been too good, so it just kind of slows down the season. But one of our goals with TaylorMade is to hopefully kickstart the season here in New York.
Equipment and gear makers like TaylorMade, Callaway, and others are hoping that the weather isn't going to put a serious damper on sales. There's a reason why the first part of the year is critical. Manufacturers want to get their wares in the hands of golfers early so that they are chomping at the bit to use them once the weather gets better. The worry is that a longer winter will cause people to postpone their purchases a couple extra months, or worse, postpone them till next year or indefinitely.
When you extend the winter by a month, you reduce the sales almost by a month in the United States. So it's not exactly a ratio of 1-to-1, but in the toughest part of the country, when it's the coldest, that's what you find.
Now, the cold winter will eventually end, but will the golf industry be able to recover and save par, or will 2014 land it in the rough? For Nightly Business Report, I'm Dominic Chu.
And from the greens to the day for the wearing of the green, 8 out of 10 Americans are doing just that as they celebrate St. Patrick's Day. The National Retail Federation says that translates into 133 million people who will feel Irish for today. The average American expected to spend $35 on today's festivities for a total of almost $5 billion, and that, any way you measure it, is a lot of green.
A lot of parades today.
A lot of parades
and I see
today.
you're wearing a green tie, so you're very much in the spirit. Happy St. Pat's Day, everybody. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And I'm Tyler Mathisen. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. Lots of green on Wall Street on this St. Patrick's Day. Stocks rallied as investors brushed aside the political turmoil in Ukraine. A surge in activity in U.S. factories last month and a boost in a key home builder confidence index also helped push markets higher. The Dow rose 181 points. The Nasdaq added 34. The S&P up almost 18 points. Another recall at General Motors, this time because of airbag and other issues. 1.5 million vehicles from 2008 to 2013 are on the list of models that need to be fixed. And more than half of Americans are celebrating St. Patrick's Day, making it a big day for retailers. Total spending on the day's festivities expected to reach almost $5 billion. Be sure to tune into Nightly Business Report right here on your public television station.